A recent survey from Clever Real Estate uncovered that over 80% of recent home buyers regret their purchase. And it's not for the reasons you think. And it can't be fixed either. Here's what they didn't see coming. Property taxes on the median single-family home have soared by more than 25% since 2019. On top of that, home insurance premiums jumped about 20% between 2021 and 2023, with Insurify predicting another 6% rise by the end of 2024. What some homeowners didn't anticipate is how rising home values, which seem beneficial, also drive up both property taxes and insurance costs. This reality hits hard, with 82% of recent homebuyers regretting their purchase. 43% have even taken on more debt just to maintain their lifestyle. Owning a valuable home doesn't automatically mean financial security. There are many hidden costs to keep that property in good shape. Most buyers don't realize their monthly payment could increase. Over 25% of mortgage holders spend more than 30% of their income on housing, which puts them in a financially vulnerable position. Here's how it works and what prospective buyers can do to prepare. Homeownership is the primary path to wealth in the United States, with single-family homeowners accumulating an average of $225,000 in wealth over 10 years. However, this wealth is largely on paper, only realized when the home is sold. There's a common saying, house rich, cash poor. You heard that? You might own a valuable home, but that doesn't always mean you have cash on hand. Home prices recently have significantly outpaced income growth, leading to the lowest affordability on record in 2023. As home values rise, so do the costs of maintaining them, like property taxes, which increased significantly for homes reassessed between 2019 and 2023. In some states, property tax increases were more than $600 a year. Local governments sometimes reassess property values to raise funds for new infrastructure, leading to higher taxes. That's why it's crucial to ask your realtor about any upcoming assessments in the area. If your realtor can't answer, it might be time to find a new one. Property taxes rarely go down. They like to go up. Over the past 4 years, property tax increases have varied by state, with New Jersey, Connecticut, and New York seeing the highest hikes, while states like West Virginia, Alabama, and Arkansas saw the lowest. Homeowners do have the option to challenge their tax assessments, and in some cases, it might be worth consulting an attorney who specializes in this. But weigh the costs and benefits before making that move. You don't want to jump out of the frying pan into the fire. Another major expense that can fluctuate is homeowners insurance. The average annual rate in the U.S. jumped from $1,384 in 2021 to $2,377 in 2023, with estimates suggesting it could reach $2,500 by the end of 2024. Natural disasters like wildfires, floods, and tornadoes have driven this spike, forcing insurance companies to recoup their losses. And some are even pulling out of high-risk areas altogether. In 2023, Florida had the highest average annual insurance rate at nearly $11,000, far above the national average of $2,500. Some states even have legislation to limit how much insurance companies can raise premiums each year. But going without insurance, it's not an option, especially for those with a mortgage. If your home is damaged or destroyed, you must cover the repair or replacement cost. As repair costs rise, so do insurance premiums. So it's crucial to regularly review your coverage and ensure you're with a company that best suits your needs. While we can't control everything, we can prepare. Prospective homeowners should understand that qualifying for a mortgage based on current taxes and insurance rates doesn't guarantee affordability down the line. It's important to research potential future costs, such as how much homeowner insurance might increase or what local utility bills look like. Even seemingly small expenses like trash removal can add up, so lean on your realtor. They should be able to answer these questions. And just because you qualify for a $3,000 monthly mortgage payment doesn't mean you have to max it all out. Aim lower to give yourself some financial breathing room. For current homeowners struggling with payments, there are options. Start by exploring your county assessor's website, which often has resources for property tax relief. The Consumer Financial Protection Bureau, the CFPB, suggests reaching out to the Department of Housing and Urban Development to see if you qualify for assistance. Also, call your mortgage servicer to discuss your situation. They might be able to offer a repayment plan or a loan modification. You don't really want to do that, but if you got to, you got to. And don't forget to shop around for insurance. Interview multiple companies to find the best fit. Or you could just avoid all of that and just rent. Because at this point in time, you may be wondering whether owning a home is a good investment at all. It's a logical and rational question these days. But here's the deal. As challenging as home ownership might seem in the short term and kind of in the long term too, now that we're looking at everything, especially with inflation driving up costs, you don't really have a choice if financial freedom is important to you. And that's a big if, because here's the reality. For our economy to keep growing, mortgage rates will eventually need to fall back to the 2 to 3% range. When that happens, home prices will soar even higher, setting new affordability crisis records. That's when the American dream of owning a home will slip out of reach for the average person, possibly forever. I mean, we're already on a path where home ownership is becoming increasingly inaccessible for most Americans. With corporations snapping up single-family homes and converting them into rentals and builders erecting entire build-to-rent communities, we're headed toward becoming a nation dominated by renters, a renter's nation. So if you're holding out, waiting for home prices to drop, you will lose in the long run. And so let me sound the alarm. This is as affordable as real estate is going to get. So if you're serious about building wealth and securing some sense of financial freedom, you want to hear this through. There is substantial evidence right now supporting the idea that waiting for home prices to drop is a losing strategy. The supply-demand imbalance in the U.S. housing market already creates upward price pressure. We've seen it as interest rates have gone up. Prices were unaffected. In fact, they continue to rise. That's not supposed to happen. The imbalance, it's staggering. There aren't enough homes available to meet the need. There's not enough roofs for the amount of people that we got. Even if prices do dip slightly in the short term, as many have been predicting will happen any minute, a prediction that's been made for years now, the long-term trajectory is clear. Demand is relentless. And when mortgage rates inevitably drop, the competition will push prices through the roof. The opportunity to buy low is a fleeting illusion. And the longer you wait, the fewer doors that will be left open for you. In a world where institutions own most single-family homes, everyday people could be permanently locked out of ownership. So I'll say this again. If financial freedom is important to you, here are 5 reasons why you want to join the smart money and buy real estate now. Number 1, wealth creation through appreciation. According to the Federal Reserve, the average home price in the U.S. increased by nearly 45% between 2011 and 2021. So if you purchased your home the traditional way with 20% down and you borrowed the rest from a bank, that's a 225% return on your investment. 22.5% annually. Can your 401k say that? Even with rising property taxes and insurance costs, homeowners have seen substantial gains outpacing inflation and the increased costs associated with ownership. This long-term appreciation is one of the key reasons why real estate remains a cornerstone for building wealth. When factoring leverage, there's no question. It's the cornerstone. Before I get to number 2, if the down payment for buying a house is an obstacle for you, but you have a 680 credit score, no collections, and no bankruptcies in the last 7 years, Bank of America has a 0% interest program just for real estate investments and business owners. I don't know why they don't promote it more, but I've helped several of my private clients get access to up to $150,000 of 0% money this month. Despite all the recession and crashing market chatter, it is still available right now at nocostcapital.com. Number 2, tax benefits and equity growth. Data from the National Association of Realtors shows that the average homeowner's net worth is roughly 40 times greater than that of a renter, largely due to home equity growth and tax advantages. Homeowners can deduct up to $750,000 in mortgage interest from their taxable income, as well as property taxes up to $10,000. These deductions can save homeowners thousands each year, effectively offsetting the impact of rising costs. Additionally, every mortgage payment builds equity, unlike rent, which leaves you with nothing to show for it financially. Number 3, long-term stability and control. A report by Freddie Mac found that the average annual rent increase has been between 3 and 5% over the last decade, whereas homeowners with fixed-rate mortgages have enjoyed a fixed payment. In high-demand markets, rents have skyrocketed by more than 10% in a single year. Bad news for tenants, but good news for owners. Number 4, leveraging real estate for lifestyle flexibility, and this is a good one. According to a study by the Joint Center for Housing Studies at Harvard University, over 16 million U.S. households own rental property. In premium neighborhoods, rent is often much lower than the cost of a mortgage. So for example, instead of paying a $4,000 mortgage payment in that premium area, you could buy a rental property in a different area that generates, say, $2,000 a month. Then that rental income could be used to offset the $2,000 rent in that premium area where you actually really want to live. By owning an income property, you get all the benefits of real estate ownership, including the appreciation, the equity growth, and tax advantages, while using the rental income to live in the premium area for half the price, if not for free if you do it right. I owned 350 rental units before I ever bought my own primary residence because this strategy allows you to build wealth through real estate while enjoying a higher quality of life and neighborhood you might not be able to or even want to afford if you bought a home there directly. Number 5, data from the Federal Reserve's Survey of Consumer Finances reveals that real estate consistently makes up about 60% of the total assets of wealthy households. Compared to stocks, which can be volatile, or bonds, which offer lower returns, real estate provides a balanced combination of appreciation, income, and leverage. Over a 10-year period, the S&P 500 averages a 7 to 10% return, but with leveraged real estate investments, annual returns can easily reach 15 to 20%. I mean, you don't have to try too hard. I'd say 25 to 30% in reality. Real estate outperforms alternatives in wealth creation, and by all indicators, real estate is the final frontier where the average person has a realistic opportunity to achieve financial freedom while they're still young enough to enjoy it, and that's key. But if you feel like you've let too much time pass to get started, I pulled this video out here special for you to watch next so you can speed things up and make up for lost time. Otherwise, I'll see you next time. Thanks for watching. Take care.